Good morning. Back in Philly for another weekend of rowing. My boys, not me. What are we talking about today? Do you know what house flipping is? It was all the rage before the financial crisis of 2008. I suppose it still is. Let me explain. At a very high level, you buy an old house or old homes, fix them up quickly, and sell them for more than the original price and effort of fixing them. That might be a little too high level. Example. You buy an old house for, one with good bones for about $100,000. You borrow the money from the bank after you put down some amount of your own cash, say 20%. So the bank's 80K, you're 20K. You got yourself a small house in need of some love. So you pour a lot of hard labor, your own physical labor, into improving that house. You redo the kitchen, you rip out the old flooring, and the old roof. You put in hardwood floors, some fancy solar panels on a new roof. You modernize the bathrooms. You get the picture. Maybe you add curb appeal, like every show on HGTV. Remember, you bought it for 100K, and let's say all that labor and material cost you 15K. Add another 10K on top of that for the interest you're paying on that loan while you still have the house. So your tab is about 125K. Well, then you sell that much improved house for, say, $200,000. You just made 75K. The bank's happy because they made 10K interest income and got the rest of their money back. You flipped that house. You deserve a television show. Go buy another house, rinse, repeat. Film the whole thing, Emmy Award. Usually, you get so good at that process I just described that you hire a crew, a person who does or redoes kitchens exclusively, one that does floors, one that does bathrooms. It's no longer your elbow grease that you sink into the next property. You have to pay the team, of course, for let's say $50,000, but you're a house flipping machine now. You do them fast and efficiently. You make less on each because you're paying a team, but you do a lot more of them. Everyone's happy. You, your crew, the bank, your viewers, the critics. Okay. If you understand house flipping, why wouldn't you? You understand private equity. Instead of buying old homes with good bones, PE buys old businesses with good bones. You don't go to your mortgage bank to take out the loan, but it's still a bank that you go to. You don't borrow small amounts of money, so there's a higher bar, but financing is financing. Instead of having a kitchen guy and a bathroom guy, a good plumber, you have a debt restructuring person, a productivity expert or two, and, a good plumber, because you always need a good plumber. Your team dives into your new business, does their magic, which we'll talk about later on this walk, increases the value of the business, and you flip it. You sell it for more than you put in. Everyone's happy. You, your crew, your bank. And it begs the question, why isn't there a private equity TV channel? I asked my son that question, what he thinks about PE TV. And he said no one's interested in physical ed, even with dodgeball, PE, gym class. He'd think that's cute, but my son's 43. Okay. Get it at a high level. Let's get into it. The investment life cycle. What actually happens if you work in a private equity firm is a 10-step process, and we'll walk through all of it. Step one is sourcing, industry jargon for finding potential acquisitions, seeing if those businesses have the kinds of problems that you and your team have solutions for, seeing if that business is a match for your investment strategy. Because even if you do have the right tools for the job, the potential returns on that specific business that specific transformation might not be worth your time. That's step one. Source. In the language of house flipping, go find some houses we can buy. How do we find them? Internal research, networking, and external research, like consultancies. And then fourth is investment banking relationships. We'll get into all of that. By research, I mean in-house fact-finding, using publicly available information to go deeper into what's available that aligns with your firm's investment strategy. It would be, we're interested mildly in mid-century modern homes in the 1960s in Los Angeles, but the business equivalent, right? That would be like, we're interested in healthcare providers in the New York tri-state region, or AI platforms and companies in the South Pacific region, some sector or geography, or some intersection of the two. The narrower, the more niche, the better. That will be, hopefully, outlined in the PE firm's investment strategy. There's a ton of publicly available information that will help you source that kind of opportunity. That's outside-in research. What else? Networking also helps you source. That means using your Rolodex, your relationships, and good old-fashioned marketing to get the word out about the kind of companies you're looking for. Lots of introductions, lots of events. That hopefully gets your broader network to help you source. Networking. The third way to source, external research. Essentially getting some niche or niche consultancies who already have subject matter expertise in your niche of choice to help you. And fourth, investment banks who have lots of clients already, businesses that ask their bank, the investment bank, to find private equity partners. Sourcing PE prospects isn't as easy as finding homes to flip because there's no Zillow app or Trulia app or Realtor app, but because it's a relationship business, prospects have a way of finding you. What kind of companies do you source? I'll talk about cash flows in a sec when we talk about due diligence, but it's worth spending a little time on what other than good numbers you look for. Well, market positioning. Is that business the Kleenex of its market? Kleenex is the best example I can think of, because even if you buy tissues from other companies, like our family buys a brand called Puffs, you can still call them Kleenex when you get home. Best case scenario, you source a company that's Kleenex in a growing market that's somewhat future-proof, maybe with tech barriers to entry, like a high cost of entry, like 3D printing. Those big commercial 3D printing machines are expensive. It's a market called rapid prototyping. Anyway, you'll also want a business that you can actually improve to grow while you own it. Why? Because private equity funds create value. They create investment returns in two ways. They use a lot of debt and pay it down rapidly, and they grow the business while they're in charge. So they look for businesses that have multiple ways to create value. Some of those ways, perhaps the previous owners didn't pursue. Diverse income streams always means less risk. And less risk, thumbs up. What else? You try to source companies that have material assets. Your bank or lender, the people allowing you to use debt to buy that business, would greatly appreciate that. Having stuff that can be used as collateral, sold if something goes wrong, or sold as a funding source once you get in. Just think about it. Would you rather buy a company with 10,000 smart people, many of whom could quit, or that exact same company that also owns, say, 10 high-rise office buildings where those smart people work, right? In a future where more and more companies can operate with people working from home, you do the math. You can quickly sell a couple of those high rises for working capital. And the other 8, well, they'll let your lenders sleep easier at night, knowing that if you fail, they'll be in the real estate business. Okay, material assets. Important, I guess, is what I'm saying. Let's say you've sourced a potential business, or more likely have a living pipeline, an endless pipeline of potential businesses that you've identified. What's next? Step 2, initial due diligence. Fancy words for getting into more details, because you can't tell if a house has good bones by just, looking at it from the curb distance. But that's all you can do at this stage. Use publicly available information to do initial outside-in research on the company, on the industry, more of it at least than you did at the initial sourcing. Publicly available information is nowhere near the level of candor and detail you'll need. So you'll want to get an invite into the house. So at this step, everyone, the homeowner, the target business, will sign NDAs, non-disclosure agreements. And once you're in the house, you do the obvious thing. You get on your knees to look into every dark, damp crawl space. What does a good house look like from the inside? Well, you're going to look for some of the things I mentioned. Market dominance, multiple paths to growth, also called value drivers. It's a term of art in the industry. You're going to look for tangible material assets, but mostly at this stage, you're going to look at the numbers, whether they have stable cash flows. Let's walk through that slowly for people who, like me, don't do well with math. The target company needs to have predictable, mature, non-cyclical cash flows. Why? They're going to need to pay down a lot of debt that they incurred when they were buying the business. They're going to want to pay down that debt using money that the business itself is making, or they're not going to get a good return on their equity. There's no good house flipping analogy that I can think of right now. So let me use a bad one. You buy an old farmhouse to flip for, say, $100,000, right? You take a loan out for $80K of that, putting down $20K, just like the other example, of your own money. Now, every month that you haven't sold that house, you're paying down that $80K from the bank with interest. Now, imagine that farmhouse you bought came with 10 acres of avocado trees, right? You would want to keep selling those avocados while you're fixing the house. That cash flow, if it were predictable, mature, non-cyclical, would help you pay down that loan, that $80K from the bank. Every month until you sold that property, you thank God for those avocados. When you sell that farm, your return would be, your equity would be so much better than if you didn't have the avocado trees, right? I know that sounds obvious, but remember, we're not talking about $100,000, on a farm when we're talking about PE. Just for some perspective, the total private markets for PE assets under management as of summer of last year was about $11.7 trillion, right? And the amount of money that was waiting in the wings was about $3 trillion. The war chest, the PE war chest. So very large avocado farms, the size of Nebraska. Okay. So you need to look for cash flow. What else? Companies with high margins, which is business speak for when you sell something for $1, you get to keep more of that dollar than, say, a lower margin business. A good example of a high margin product would be like candles, the ones that smell like springtime or falling rain or some nonsense. Cheap to produce, but priced for people who clearly have too much money. What else? A stable cash flow, high margin businesses. Oh, 3, low capital expenditure. They have to spend relatively little to maintain equipment. So just to kill that example of the farm with the avocado trees, if you can pick the avocados by hand, yay, low capital expenditure. If you need to buy an avocado picking machine or two or three, or God forbid, you have to replace those machines every month, high capital expenditures. You're paying a lot for, you know, machinery. In that example, it doesn't mean avocado farming with high capital expenditure is a bad business. It's just not ideal for flipping that house, right? Or that business. Because with private equity, you don't want to keep going back into your pocket for more cash. In other words, you want to source a company that has low working capital requirements. Every time you reach back into your pocket to take out more cash, that's working capital, and it's lowering your fund's ultimate returns. The less you go into your pocket, the lower your capital injections, the more flexibility you have to spend elsewhere to run your operations. So capital-intensive projects attract lower valuations. They're not as interesting. And you want to discover all of that during this stage, initial due diligence. This is where, this stage is when you start your conversations with your debt partners, whoever's going to help finance the deal, your bank or bank-like entity, because whoever they are, they like to be brought in early on potential deals. We all do. They're going to have views on the business, views on your debt financing options. They're going to want to talk about the costs of different debt instruments, what they have to offer, and how to balance the level of debt with the returns that you expect. The how of financing. You'll need to loop them in because they're your silent partners, except not so silent. With all that out of the way, you're ready for step 3, your first investment committee review. What is an investment committee? Okay, usually it's just the senior-most people in your organization in the PE firm, hopefully with different skill sets, different perspectives, different experiences. And if that committee review goes well, this step generates what's called an initial offer to the homeowner, the prospective business. Now, this first offer is non-binding, which means that neither party is legally obligated to carry out its terms. But it's enough, to signal that you're interested as a buyer and serious enough that you want to dive deeper, get more details. Not ready to pay yet because you need a full home inspection, to keep killing this analogy, but that's how you get an invite into the house. Probably worth mentioning, a PE deal can be public or private. Your sourcing might have you targeting a privately owned company, entirely owned by private shareholders, think like a family business. Or you can actually target public companies listed on a stock exchange. Step 4, a detailed due diligence. This is where you're finally crawling around under the house, usually with a small army of accountants, looking closely into every dark and damp corner, every dark and damp crawl space. That's how you find not whether there are bodies buried under the house, but how many. There will always be bodies. Detailed due diligence. You don't fear dead bodies. You just need to know the effort it'll take to exhume and bury the dead, preferably in the middle of the night. Okay. Who on the team does this crawling around? Usually an accountant and or a tax specialist and or a lawyer who is good with contracts and or other functional specialists. The point is, PE, the process, appreciates specialists, fine-tuners, because the previous management team was tuning, maybe not fine-tuning. While the functional specialists do that, the internal team beefs up their Excel spreadsheets, their modeling, their PowerPoint presentations, their investment case, their preliminary investment committee paper. You get the point. They're digging further and further into the market opportunity, the stuff we talked about, the company's returns, and whether the deal continues to meet the return expectations of the fund. That model, which the deal team will present at the next step, will need to speak to the key operating assumptions that everyone on the investment committee should agree on. Things like the price of whatever that business they're buying is selling, right? How much they're selling, how fast their customer base is growing, renewal rates, fixed costs, variable costs, how their margins are changing over time, how their earnings will grow over time, and all the assumptions that go into answering that string of questions. That's how you get to an accurate IRR, an internal rate of return, IRR, the annualized rate of return expressed as a percentage. That's how you get to an MOM, multiple on money, MOM, the ratio between the total cash inflows received and the total cash outflows. These are the data points that will make or break the company during the PE team's ownership period. The point here, as you get more and more information, you hopefully make fewer and fewer assumptions, all the while asking, is this business the right next house to flip? Step 5. You're back in front of your investment committee with an update, on what you've dug up, quite literally, upon closer inspection, and how what you've seen has changed your thinking about the deal, the opportunity, its terms, potential returns, if you were to invest. If there are any open questions, you resolve them at that next step. Before we jump there, though, let's walk through the typical deck that will be presented to the investment committee. Think of it as the PowerPoint template of everything we've talked about on this walk so far. First couple of slides would be the deal summary, the investment thesis, transaction details, high-level summaries of risk. If any member of the committee has been sleepwalking, these will wake them up, these first couple of slides. Give them the background on the deal, where it started, its journey to date. You put these slides in, essentially, so everyone in the meeting can stop thinking about the meeting right before this one that they were in and, context switch. If anyone asks anything on these first few slides, the speaker either answers, great question, we'll get to that on slide 7, or great question, that's in the appendix. Just once, I wish someone would answer with I don't know, we're predicting the future here. How accurate could you be? But that will never happen. I would shake some very well-dressed people down to their core. Next set of slides, the middle of that deck, will be the details about the company, the management team, the business model, their differentiators, their competitive advantage, their market position, their addressable market size, and all this is historical, numbers-heavy, graph-heavy view, things like fixed costs, variable costs, margins, that whole list I threw out there. And think about it over time and projected into the future. All the graphs do that. Customer growth, renewal rates, earnings past and present, maybe a little bit of forecasting into the future. Anything that will indicate future performance or get the right conversation started. If you've ever read the financials of a business or done the accounting on it, that's mostly what this middle part is. Revenue, earnings, cash flows, and an explanation of how the deal team constructed their financial forecasts, the investment that they're making. They're just flexing their Excel skills. And who can blame them, right? The last two parts of the deck are the valuation and the exit details. The valuation, which is just a fancy word for how much should we pay for this opportunity? The word itself, valuation, means the process of figuring out the present value of an asset, any asset, in this case, a business. And how do you figure that out? Remember, all the numbers and forecasts in the middle of the deck, remember what we just talked about? There are common methodologies, think Excel formulas, that are applied to all the business numbers. Generally, it's belt and suspenders on the valuation formula. You don't pick one methodology, one formula. You apply several and triangulate to a consensus number. Okay, that sentence wasn't helpful. Imagine there were 3 business professors, each with a unique way to price a business, each with a slightly different Excel macro. You run all 3 formulas against your numbers, and each one gives you, it's like a slightly different number. One would be like, let's pay 10 million for the business. No, 12 million. No, 15 million. You smush them together, triangulate to get your number. One that shows you played out all the scenarios, that you did the math, that you were thoughtful and multidisciplinary. And finally, the punchline to the whole joke, the expected return on the investment. That deck's most important part, the conditions for the exits. Will it be a sale or an IPO? When? How many months or years will it take? And this part comes as a set of ranges, return ranges, each with its own set of assumptions. And the ranges, because remember, we're predicting the future. Okay. Where did we stop before the deck? Step 5, the second investment committee review. Let me do 6 through 10 fast so we can talk about debt structuring, an important term I'll explain shortly. So, step 6. This is also where your partners in the potential deal do their due diligence. For instance, the bank that's financing the deal, they'll want to look at the house. They'll want to look at your plans for it. They'll have their own set of questions. The term of art for this step is confirmatory due diligence. I was probably on the... Okay. It's jargon for that part of the wedding where the priest asks if anyone knows any reason why this couple should not be joined in holy matrimony. Speak now or forever hold your peace. That's confirmatory due diligence. Step 7, we bring all that back, all the answers to the investment committee because we don't want to waste their time, hence confirmatory due diligence in that last step. And we ask the committee for approval for a final binding offer. Why do we ask for their approval? Depends on your philosophy of life. I, for one, would think it's because we are collaborative, consensus-building animals that understand that you get better outcomes through diversity and inclusion. Someone else with a different philosophy might think we get committee sign-offs because, if the deal goes pear-shaped later, all asses are covered. Potato, potato. Okay, step 8. That final binding offer, the one we just got approval on, it's signed, well, hopefully signed by everyone. Lots to consider at this step, like when you're closing on a home purchase. For instance, if the deal is keeping the company's current management team, something called a management equity ratchet. That'll need to be part of the closing. This is also the step when money exchanges hands at the signing, right? Exactly like when you're closing on a home purchase, except for a lot more money. And once the closing ceremony is done, the fun begins. Step 9, bring in your crew, have them do what they do. Step 10, flip that house. Okay, that's the process. I'll explain what happens in step 9 and 10 more in a second. But before we jump to that, let's quickly talk debt structuring. And we should probably have started the walk here, given how important debt is to an LBO, a leveraged buyout. What is debt structure? If you're going to borrow money to acquire debt, you're going to want to know and to negotiate the terms of the loan, the interest rate you're paying, the repayment terms on the principal, the prepayment provisions on it. Like, what if you win the lottery and want to pay it off early? Will there be prepayment penalties? These are all questions about your liability. That's a term of art, even though you use it in general life. Your company's liability, all the responsibilities that fall on them as the company takes out a loan. And those terms, that debt structure, is or the most important factor in how much money you're going to make when you flip the business. The loans you'll be taking aren't like mortgages where there's some standard interest rate, some 30-year fixed rate that everyone uses. Your deal's terms come from your relationship with your lender. You're going to negotiate terms with them, and they'll make their decision based on the strength of the business case, that deck we went through, their own due diligence, your track record with past deals, your collateral, what you're putting up. But most importantly, it's your reputation, your relationship with them. Money is a relationship business. It's all about trust. But you knew that, so let's get into stuff you don't know or might not know. Okay. 3 different types of capital typically sit within an LBO structure. Bank debt, high yield, also called subordinated debt, and equity. Don't worry, I'm going to define them. One's easy. Bank debt is the money you got from the bank. No duh. 2, high yield or subordinated debt. That's debt that ranks after other debts if a company falls into liquidation or bankruptcy. They use the word subordinate because that class of investor isn't first in line. They're second to bank debt. If everything goes boom, you pay the bank first, then the subordinates, and if there's anything left over, you toss it to the people with equity. I did a video about mortgage-backed securities, which I talked about something called a CMO, a collateralized mortgage obligation. And how if the plane goes down, that's the terrible analogy I use, and there's only one exit door, and it's in the first class cabin, that determines who gets off the plane first safely. Well, in most LBO structures, the banks who are financing the deal have all the first class seats. They get out first. Then business class, the high yield subordinate debt we just talked about, then economy, the PE equity folks, the losers in the back of the plane. You can see how that would be a neat ordering of default risk, which I didn't define. Default risk is the probability that the other party in an investment doesn't fulfill its part, their part of the deal. They default, like when you default on a loan. In the case of a default risk, in the case of a plane crash, in the case where the company you bought were to, God forbid, go bankrupt or need to be liquidated, the structure is the order in which people would get paid. So bank debt gets paid first, then high yield, subordinated debt, then equity. It's an active, thoughtful trade-off. The less risk you take, the less you make in these deals. And the more risk you take, the more you make in these deals. Should probably make that tangible. Okay. If you're a bank sitting in first class, the seats with the least default risk, the safest, you make somewhere in the range of, let's say, X% on that deal. If you're in business class, high yield, you're middle of the plane risk, you're probably making 2X percentage. The bank's 5% win would be your 10% win. And if you're in the cheap seats, those folks holding equity, the actual PE firm, the last to exit the plane if something terrible happens, you're making easily north of 4X as a percentage. And that last number could be a whole lot more if you and your team do your job well. Back in the day, it could be like 20X. It's not like that anyway. In this kind of structure, those in the first class seats, from a risk perspective, will make up the majority of the plane. Like 50% or more of the debt that you're using is first class because it's cheap money. It comes with, not from, the lowest interest rates. High yield or subordinated debt will be this thin percentage slice in the middle of the plane, and it's used sparingly. Think like 10%, maybe 15% of all the seats. Why use any of it at all if you're a PE firm? Well, the economy seats need those business class seats. Those business class seats minimize the amount of equity that you would need to sink into the deal initially. To kill the plane analogy, you can use high yield so you have more economy seats on that plane. Because the more economy seats you have when you successfully land the plane, the greater your returns. Okay, let's do an example with small numbers, which I'll put here when I get home. You source a company that has earnings of, I don't know, $10. You'll need $100 to buy that business. Your very impressive banking relationships step up and promise you 50% of all that money, all the money you'll need, like $50. You tap high yield for another 10% of what you'll need, $10, and you'll sink in your own money for the last 40% or $40 from your own PE fund. Given that it's a $100 deal, this setup would give us a 60% debt to 40% equity split, hopefully up here now, when we first buy the business. People in the language, in the world of PE use the language of leverage when talking about LBO structures. The word leverage itself means a multiple of debt over earnings. It's shorthand for some very basic, very easy math. Two main kinds of leverage: senior leverage and total leverage. Senior leverage is all the money from the first class seats over earnings. In our example, it would be like $50 senior debt over $10 earnings, or 5x senior leverage. 50 divided by 10 is 5. And total leverage is first class plus business class over economy. $50 senior debt plus $10 high yield over $10 earnings, or 6x leverage. Easy math. The higher your leverage multiple, what's better than 5x? 6x. The higher your leverage multiple, the more debt you're using for the acquisition, the greater your returns if you successfully land the plane. More debt equals outsized returns. Plus, always remember that PE firms aren't doing just one deal a year. They're hopefully doing many, and many simultaneously. So each deal is going to lock up some of their equity, their ability to put money down on the next house that they want to flip. So lots of good reasons to bulk up on OPM, other people's money. Not a banking term. lots of good reasons to bulk up on debt. Lots of good reasons to shoot for higher leverage multiples, higher senior leverage, higher total leverage. And it's worth noting, the level of leverage in an LBO depends on the target business's cash flow, because that's the best indicator of how quickly the team will be able to pay down the debt. If you're their lender, the larger the target business's cash flow, the more you're willing to lend, the less you're willing to charge in terms of interest. All because you're betting on more and more of a sure thing, taking less and less risk, but still making a percentage return that makes you happy, your institution happy. Okay, jumping back to the larger explanation. Spent like one sentence each, I think, on steps 9 and 10, and I sounded all rhymey like Dr. Seuss. Bring in your crew, have them do what they do. And that might have been the highlight of this walk, now that I think about it. But it wasn't enough. Let's talk about what happens once the house is yours. How do you get it ready to flip? And this is the heart of PE. Let's use some fancy words. How do you manage your portfolio company? How do PE funds create value? Let's start with the soft stuff, relationships. If the PE firm keeps the old management team in place, they'll need to build a strong working relationship with them. We're not talking micromanagement because remember, the PE firm doesn't just do one deal at a time. They have their fingers in a lot of pies. So their job, their approach is to set that management team up for success. The easiest way to do that is soft. It's introductions. You should meet this person because they'd make a great hire. You should meet this person because they'd make a great customer. A great supplier, a great advisor. If the PE firm has been around for a while, they'll have a long list of existing companies that they're plugged into, and an even longer list of former companies that they have deep relationships with. So these introductions aren't cold calls. They're introductions to, my good friend so-and-so and my old friend so-and-so, people with whom they've spent cold nights in foxholes, enduring relationships with people who many times feel indebted to the person doing the intro. That's the best kind of intro, just so you know. So some of those intros will be to other portfolio companies, creating what's called portfolio synergy, my least favorite word, synergy, where the intro will sound to both companies a lot like a mandate from the owners. Now, seriously, if you've never been a business owner, you dream about these kinds of intros. Before we jump off the soft value adds, the relationship-based ones that we've been talking about, the other way that PE funds set up management teams for success is by helping build up their boards. Need someone with even more connections than the PE team brings? Senior board member. That's your answer. Okay. What other ways can the team create value other than the soft relationship stuff? Operational expertise. What are examples? Let's say you need fewer defects on your assembly line for the company that you bought. There's an app for that, a specialist. Having a hard time navigating regulatory or compliance issues? There's an app for that. Problems with customer satisfaction? Too much waste in your value stream? Are you losing customers left and right? There are apps for that. Specialists sitting in the PE firm or directly outside the PE firm with a relationship to that firm, and they're a phone call away. The best example of skills that already sit in that PE firm that the company can use is help with structuring and restructuring debt, because you wouldn't be in the PE business unless you were a world-class operator on the use of debt, on optimizing capital structures, finding that profit maximizing equilibrium between debt and equity in any business. And these debt experts are already swarming the business for their own reasons to accelerate what's called deleveraging, fancy words for just quickly reducing the amount of debt in that business by, paying it down, by growing and redirecting cash flow from that business. What else? PEs help set strategic priorities. That one's obvious. You don't buy a house to flip without a vision for what you want it to look like before you sell it off again. That's strategic priorities. And I left my favorite bit of value add for the last: bolt-on acquisitions. You've just bought a pizza oven company in Akron. Now it's time to buy a dough-making factory in Cincinnati, a cheese-making concern in Columbus. Tomatoes are us in Cleveland, and I'll stop there because I don't know any more cities in Ohio. Plus, I'm cool with plain pizza. Bolt-on acquisitions can take a million shapes. They can be as simple as buy all the competitors in your acquisition sector, to buy adjacent functions to broaden that core offering that your company that you bought has. Your imagination is really the limit, your business imagination. In tech, we call that platform thinking. There's a network effect, obviously, the creation of a less constrained, more borderless business ecosystem that produces a multiplier effect. That's what a network effect is. 1 + 1 = more than 2. That's the advantage of a platform. And that, broadly, is the kind of value that's added day after day, week after week, sometimes for months, sometimes for years, until you can see the light at the end of your business flipping tunnels. What comes next? The exit. When exactly do you flip that business? In practice, it's hard. It depends on how and how much you've improved it during the ownership period. It depends on the state of markets, macroeconomic conditions like interest rates. It depends on whether there are buyers out there, whether you're serious about doing it and whether they're serious about buying. In theory, though, the theory is a lot easier. Long before you bought that business, while you were still making the case for buying it, that deck, you'd have a sense of how you plan to improve the business. You might be, when you're ready to exit, it might be like the earnings get to a predetermined size that you set. You might be ready to exit when it was generating a certain amount of cash flow that you set. You might be ready to exit when it grew large enough or strong enough to attract a higher valuation multiple that you set. The point here is that in theory, PE funds have a plan, an investment thesis. We'll first focus on scale and fixing margins. That's a plan. We'll next focus on sales and fixing gross margins. That's a different, equally valid plan. We'll then focus on capital expenditure, CapEx, and fixing margins. By the way, everyone loves fixing margins. Another equally valid plan. They all simplify it to some combination of make money, make more money, and spend less. There, an MBA in like 6 words. Make more money and spend less, 5 words. But what do we know about every plan? Philosopher extraordinaire, Mike Tyson. Everyone has a plan until they get punched in the mouth. That's why I said, like 10 feet back, that in practice, it's hard, right? It takes agility, experience, and what no one will ever admit, some luck. 3 different exit options officially: an IPO, an initial public offering, a trade sale, and a secondary sale. IPO is where the portfolio company gets listed on a public stock exchange with the help of an investment bank. That you take them public. Whether you can actually land that outcome will depend on market conditions. If you're lucky, the market will be up, frothy. Companies will be attracting higher valuation multiples, which is just a way of saying that people will be willing to pay more for them, which will obviously be a boon to the PT fund's returns. By the way, as exciting and profitable as an IPO is, that's never the end of the journey for the PE fund, because they're not allowed to sell their full stake on day one of the listing. The markets block them from doing that because no one wants to buy something that the owners look desperate to sell, that they're as desperate to get out of, right? It's a market protection mechanism implemented by the exchanges to protect everyone involved. If you're lucky enough to go public because of a PE deal, and you're on the PE side, you're stuck in that position for at least a year or 2. Not that you care, because your personal stock just went up. Remember how I said money is a relationship business? It's all about your reputation and your relationships. Well, if you go IPO, it's a whole lot easier when you go ask for more debt and financing for your next deal. The buildup to the IPO, it takes about a year working with their investment bankers, the PE team, will work out the details of two different offerings. It's called a primary and a secondary offering. Primary offers new shares in the company, bringing in new investors, new money. While secondary doesn't create any new shares, it just sells the PE firm's existing shares. Those equity seats on the plane, the economy class, now a lot more expensive. So when you hear about primary offerings and secondary offerings, when you read about IPOs, that's the difference. Next potential exit option, a trade sale. That's where you flip the company, you sell it to a strategic player, again, with the help of your investment bank. Unlike that 1 to 2 year wait on cashing out when you IPO, a trade sale gives you a full exit. You get all your money. Liquidity is, a beautiful event. It's a beautiful thing. All the senior partners at the fund will be dancing. This outcome isn't as market dependent as an IPO. Whoever you're selling to has to be very well capitalized. Fancy words for they need to have a thick wallet and a good reason to spend, which means you're going to need to sell to winners because middlers and lower performing companies won't have the kind of cash you'll be charging. You could, in theory, sell it at a lower valuation, but again, remember, it's a relationship business. So your reputation is tied to your portfolio company's valuations. With a trade sale, the PE firm's investment bank will manage a 2-stage sales process with an initial bid and then a final bid. Usually it takes about 12 months. They usually use an auction format to amp up the drama, trying to build some tension into the auction to maximize bid prices. Actually, another good source of drama, and it's pretty common, is running both the IPO prep we talked about and this trade sale auction at the same time. They both take about a year. And if you're a potential buyer in a trade sale, you're having your emotions played with by the investment bank because, it looks like they could do it without you by going IPO. It's also a bit of FOMO, fear of missing out. So, your investment banker will run both preps simultaneously and keep playing with buyers' emotions up until the last possible legal moment to pull out from one or the other. It's quite clever, actually. That's why investment bankers get paid nice amounts of money. Third exit option, what's called a secondary sale. You pawn off your business on another private equity shop, usually a bigger one than you, because you've grown the company that you bought during your ownership period, which means the buyer will need to pay more than you paid when it wasn't as big or as well run. Who can pay more? Shops that are PE shops that are bigger and better capitalized than you. You tend to exit this way. Everyone's happy when you exit this way. You get all your capital out. Your investors are happy. +1 on your reputation score. There's no drama on this one because the buyers, the other PE firm, use the same tricks as you do. There's a little bit of market dependency on this one because the buyer also uses what we've been talking about on the walk, bank financing, debt, the structuring we talked about. They'll have a plane too with their first class seats, their bankers, and their business class seats, their high yield, ... It's market dependent because markets determine financing costs, not just relationships determine that. The cost of the tickets on the plane, the cheaper the cost of debt, the more likely you can exit through a secondary sale. That makes sense, right? For the same reasons you buy more houses when interest rates are low. Okay, only thing left to cover is what do you do with all that cash after the sale? This is where I wish you'd watch my video on MBS, mortgage-backed securities. Short answer, everyone exits the plane. And as they're exiting, they get their checks, their cash. There's only one exit. It's in first class. So first class cabin exits first, the bankers. They've been making money all along because their money came with interest payments. But if you weren't able to pay down all of that debt during the ownership period, well, they get their remaining balance as a check as they exit the plane. It's an orderly exit from the plane. So who's next? The business class seats, your high yield subordinated debt. Again, if you weren't able to pay down all of that debt during the ownership period, they get their remaining balance as they exit the plane. Hmm. And then the cheap seats, economy class, the actual PE firm. But unlike every plane deboarding you've ever experienced or seen, the people exiting last off the plane aren't pissed off. They're not tired and angry. They're jubilant because they keep everything else. They just made a shit ton of money. They go have a nice celebratory dinner and then get to bed early because they still have and will always have a lot of other planes in the air. That's it. I hope you got something out of it.